guys, welcome to the Grief and Potluck podcast. Today we are going to have a small chat about death and taxes. I know. Already you're saying, good grief. Are you kidding me, Ginger? No, I'm not. Death happens, taxes happen. There is a sweet side. I'm not quite sure what that sweet side is, but we'll figure it out. Sometimes people want to leave all their financials to their pets. Kudos to them. Sometimes you just want to party down in a blaze of glory till the very end. Kudos to them. And sometimes life gives you lemons, and those lemons are not that sweet. However, I think strawberry lemonade's supposed to be tasty. Nonetheless, you do your homework. You do your homework, we do your homework. We don't always do your homework. But thank you for joining us on this episode of Grief and Potluck. So today, while you enjoy that little slideshow over and over and over again, we're going to have a small chat about death taxes. They are imposed by federal and or state governments upon someone's death. These taxes are levied on the beneficiary who receives the property in the deceased's will. So if you're the lucky one, you're going to get something. What states have death tax? Well, currently I'm showing as of 2018, Washington and Oregon are the only Western states with a death tax. So a death tax are deductible against the federal estate taxable income, not the federal estate taxes. Confused? It's taxes. I know. So, do dead people have to pay taxes? When someone dies, taxes are not going to be the first thing on your mind, obviously. But at some point, if you are the heir of the deceased, or said beneficiary of the deceased in their trust, you have to address some of these tax situations. Also, there is a state with no inheritance tax, Alaska. No state income tax, no estate tax, or inheritance tax. How nice. I understand recently New Mexico changed their stats, and if you live to be 100, somehow you don't have to pay some kind of tax. Oh, I know. I found an interesting article in Forbes regarding 8 things you need to know about the death tax before you die. It's convenient. Quite, right? Convenient to know a few things. So, we're going to scroll down to not listed in number order, but quite frankly, here's some basics. Jointly owned property is included as we are regarding the death tax. So, if you own property jointly with your spouse, then 50% of the value is included in your gross estate. If you owned property jointly with someone other than your spouse, 100% of the value is included in your gross estate, unless you can prove that the other party contributed some or all of the value. Doesn't sound too promising. Take every deduction you can. Your estate can deduct administration expenses such as legal and tax fees. You can also get additional deduction for any monies left to charity, which is why a bunch of millionaires and bajillionaires tend to do that. Make sure you understand the marital deduction. If you are married to a U.S. citizen, you will get an unlimited marital deduction for the assets you leave to your spouse. You can leave $100 million to your U.S. citizen spouse, and no estate tax will be due. That's nice. However, if your spouse is not a U.S. citizen, the unlimited marital deduction is not available. The IRS is concerned she may go back to her country of origin and therefore take it with her or him. I know. Taxes get silly. Large gifts are part of the calculation, and every asset matters. Now, again, that's on Forbes.com. Pretty much 8 things you need to know about the death tax before you die. Thank you, Christine Fletcher. The other situation, which I found on a helpful website called thebalance.com, is learn about the taxes due after someone's death. When someone dies, taxes are not going to be the first thing we think about. While estate taxes seem to get all the publicity when it comes to taxes owed after someone dies, the reality is the majority of estates will not owe any federal estate taxes. Why? 2020, the federal estate tax exemption is $11.58 million. So, most of us may not have that lying around. Ta-da! The exemption will only continue to be adjusted upwards on January 1st of each year due to inflation. Nonetheless, estates valued at $11.58 million must file a federal estate tax return using IRS Form 706, which is officially called the United States Estate and Tax Return. Yeah. So that gets into a few other details. State of estate taxes. While most estates will not have to file a federal estate tax return or pay any federal estate taxes, residents of the following states who own real estate in these states may owe state estate taxes. I know. Tough pill to swallow. Here we go. Connecticut, District of Columbia, aka DC, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New Jersey, New York, Oregon, Rhode Island, Vermont, and Washington. And on thebalance.com, you can click on those states to go further and find out some intel. Now, while on estate tax, it's a tax based on overall value of the deceased person's estate, inheritance tax is based on who receives the deceased person's property. Currently, only 6 states collect estate inheritance tax: Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. So if you live in Maryland and New Jersey, you're getting estate tax and inheritance taxed. Then there's a gift tax. Then there's generation skipping transfer taxes. That sounds wild and crazy. At the federal level, generation skipping transfer taxes, known as GST taxes for short, only apply to estates that owe federal estate taxes where some of the estate is passing to someone who is a skip person, or some of the estate is passing into a trust that is a generation skipping trust. The skip person is a relative who is 2 or more generations below the deceased, excuse me, or an unrelated person who is 37 and a half years or younger than the deceased person. I know that's really awfully specifically weird. Nonetheless, at the federal level, the generation skipping transfer tax exemption is the same as the estate tax exemption, which means the exemption is 11.58 million, as we mentioned earlier, in 2020. Income taxes. Okay, now we're speaking a word I actually might know in all this blase tax. Blase. I know. Smack your forehead. It's a bumpy ride, these taxes. So, of course, if the deceased person had an income tax, you got to fill out a tax form for them. There will be a period of time while an estate or trust is being settled after someone dies. Thank you, the balance. We're on number 6, the income tax.com. So, estate or trust is being settled after someone dies, and the estate or trust will earn interest prior to the time the assets can be distributed. Oh, goody. While certain types of assets owned by a deceased person will receive a step up in basis. If these assets, such as stocks and bonds, are sold after death, then the sale may result in a capital gain, even after taking into consideration the step up in basis. Now, what is the step up in basis? I don't know, but according to thebalance.com, you can click the link there, and now we are on the article that states how a step dash up in basis can be good at tax time. So literally, how a step up in basis can be good at tax time. All of those are individual words. We're gonna skip that because that's messy. What should you do? If you're not sure if your loved one's estate or trust will be subject to any taxes, or if you are not sure if what you have inherited will be subject to any taxes, consult the estate planning attorney, tax attorney, or accountant to be sure. AKA, do your homework. Must do homework. I know. We're grown-ups. We don't like homework. But there is a lot to deal with, unfortunately. Now, one more sad bit, just one, and then I'll give some happy news. Okay, I know, a few lemons. Another Forbes article, seems to be a trend, printed in November of 2020. Biden's tax increase on death that no one is talking about. Oh. So, Robert Wood, apparently he likes to talk taxes. Most people think primarily about income tax, not estate tax. That makes perfect sense. Very few people end up paying estate tax or even having to worry about it at all, with a $23 million allowance per married couple going free of gift or estate tax. Only those over that number face taxes. Yet Mr. Biden's tax plan reflects a massive change in how income and estate taxes interact, amounting to a big tax increase that will transform income taxes on death. First point, Biden has proposed taxing long-term capital gains and qualified dividends. But how about on death? Question mark. This is where the change is much bigger. Recall a Clinton proposal of 65% death tax for the very rich, and Bernie Sanders more recently saying he wants to drop the 11.5 million exemption to a 3.5 million. Well, That doesn't sound too pleasant. Currently, up to $23 million per married couple can pass to one's heirs free of federal gift and estate tax. Now, since Biden's plan could leave you paying higher income taxes after a death, by repealing present laws, step up in basis. We talked about that one a second ago. The step up, so step dash up in basis, that increases the tax basis for inherited assets to their full fair market value upon death. Biden's tax plan calls for carrying over an asset tax basis from the descendant to the next generation. No amount of estate tax exemption would help you, because this is a big income tax increase. Right now, the businesses goes free of estate tax to the kids if both parents die. The $23 million estate tax exemption should mean no estate tax for that $20 million business. Okay. So Junior can run the business or sell it for $20 million and should pay no income tax. Or Junior could try running the business for a year or two, might even be worth $22 million. But if he sells it, he has that $20 million date of death value basis. And yes, this is a simple example he gives, as he states, most buyers won't buy stock and insist on buying assets, and the business would be taxed. Remember, on a business sale, the company, owners, or both may have to pay the IRS. So, Robert Wood is a contributor to Forbes, and he likes to talk about taxes and litigations. So that was an article in November of 2020 titled Biden's Tax Increase on Death That No One Is Talking About. Enough of that depression. On to the sweetness. Oh, the sweetness. I know, we're back to lemons on the picture, but I promise it's going to get sweeter. Just for a quick nibble. Tax-friendly retirement states, if you make it that far. So, apparently on retirementliving.com, we have looked over the situation at large and found about 10 tax-friendly estates for retirement. Okay, we'll go down the list. And again, this is on retirementliving.com/top 10 most tax-friendly states. I won't go into too much detail, but I'll give a quick review. Wyoming is number 1. Alaska is number 2. South Dakota. Ooh, that's very cold. Mississippi. Okay, Mississippi. That's a weather situation we got going on there. Florida, woohoo, is another one. And again, weather. Pennsylvania. Nevada. New Hampshire. Kentucky. Georgia. And that's it. So those are 10 friendly vis-a-vis taxes. So if you're looking to deal with your, state taxes, taxes, estate and inheritance taxes, and if you move, those are some friendly states. I recommend looking over this article. It is titled literally the top 10 most tax-friendly states for retirement. And it was printed in January of 2021 on retirementliving.com website. And hopefully, again, you can learn a little bit more, because yes, we do have to do our income taxes. Blah. But then, Merry Christmas, you die. And then there's more taxes to deal with. Good grief. So, I'd like to give a quick shout out to retirementliving.com, thebalance.com, and the less than happy information on Forbes.com. for that tax death intel. So I highly recommend that you talk to an estate person, a tax person, an accountant person, get some intel, do your homework, get a few people to give you a few different bits of knowledge, because clearly there's a lot going on. And, every asset matters. And it helps to get stuff ahead of schedule, because we never know when it's our scheduled time. All right, guys, that's just a quick do-ha in dealing with death and taxes. I hope I didn't depress you too much. And more intel will come. So again, if you want to leave it all to your pets, okay. That's your call. If you want to live it up to the end, okay. That's your call. Yes, life will throw you lemons. Won't always be beautiful. Won't always be perfect. But that's okay. If we do our homework, we'll be more informed, more educated about the basics, and therefore have a clue as to what to do at the end. Thank you so much for joining me on this Grief and Potluck podcast. I look forward to talking with you again soon. Have a great day.